Hi, this is James Ing with O Capital, and we've got Mark Allen here with GREA. Mark, how's it going, man?
Good, James. Thanks for having me.
Yeah, no, thanks for jumping on. You guys will be at the conference in October at the O Capital conference, and so I wanted to bring you on, just introduce yourself and your firm. So yeah, just to kick it off, give people a little bit about your background and how you sort of got started in the space, and then a little bit more about GREA.
Sure. So I went to West Point, the U.S. Military Academy, had to serve in the Army and pay back my college education. So that brought me down here to Texas. During that time, I got a $35,000 loan at 0.5% interest rate, which they do for ROTC cadets and the Academy cadets. And it's a career starter loan. So, anyways, I bought real estate with it. So that kind of got my feet wet with real estate investment. And eventually I ended up getting my license as I was getting out of the military just to have it. And during that time, I was actively doing single family residential, fix and flips, buying whole mortgage wraps, all sorts of stuff. And I got out of the military and took a job in software sales in Dallas. So I did that for less than 2 years and then decided to make the transition full time into real estate brokerage, specifically multifamily brokerage, obviously. So
All right. Yeah.
I've been doing it since 2016 and I've been part of the same team ever since. But we have rebranded a few times and we are GREA, which stands for a lot of things, really. Whatever you want the G to stand for: gangster, global, generational. No, but I guess technically it's Global Real Estate Advisors. We were formerly part of Greystone as a JV partner, and so we were called Greystone Real Estate Advisors internally. So it's kind of the genesis of the name GREA.
Change it over to global. That keeps
Yeah,
everybody that
so we
that's
didn't
like
want to get sued.
it's like the total addressable market. Like how big's the market? Well, this is a global global real estate firm, so it's worldwide. But talk about um, sort of how many offices across the nation do you guys have, and what about the Dallas office? Like about how big are you
Yeah.
guys right now?
Yeah. So Dallas office in particular has 17 brokers. And I think we have 6 support staff at this time. And we have 12 offices across the country. That would be Dallas, Houston, Northwest Arkansas, Miami, Atlanta, uh, Detroit, Chicago, Philadelphia, Raleigh, and New York City. I think I hit them all.
Yeah.
And we were growing just through essentially mergers of established either companies or existing teams that are multifamily specialized. So we're a multifamily specialized firm. And our focus is to grow West Coast, specifically Phoenix, Denver, Los Angeles, and Seattle, hopefully here in the near term.
Okay. All right. So you've been in Dallas for a while, and you've seen sort of the crazy cycle of 21 and 22, and now back to a little bit of a slower pace here the last couple of years.
Yeah.
I guess from your side of the table, what has the last couple of years felt like and been like, and sort of what are you seeing right now?
Yeah, I mean it's a lot slower. I think 2022 was our best year, and obviously the market started to get a little bit choppy and started to slow down as the Fed started to hike rates in what, March of 22 is the first hike, or
Right.
April.
Yeah. Yep.
Um, and so we were down considerably last year. We were down about revenue wise about 50%. I think it was probably pretty similar as far as number of transactions. We were down about 50%. And this year actually we're looking year over year. We're going to be up. So first half of the year was better than last half of the year for us. Although if you look at the Dallas data, the first half of the year this year was actually slower from a transaction velocity and volume perspective versus the first half of 23. So it's slow. I mean, me personally, as far as production listings or off market deals, I went from nearly 30 deals in 2022, 30 closings down to, I did a dozen last year, and I think I'll probably be about, the same this year. I did 27 sales in 22, so that's also down more than 50%.
Right.
So
And
it's a
then,
tough time to be a broker or a real estate service professional.
so I mean, obviously rates are still relatively high, but deals are still getting done. Talk about how those deals are getting done, whether it's the seller, are they in distress, or they've been in the deal for a long time. Talk about some of the deals that have closed this year and sort of what got them to the finish line.
Huh, okay. I wish I had the list up in front of me so I could go through the motivations,
Just
but
pick
any,
a couple that that come to the top of your head on just when you're talking, because I think when I talk to brokers, a lot of them are doing a lot of BOVs, right? So you get the BOV, you put it in front of them, and then you don't hear back, and you're like, what's going on? But for the guys who did call you back, like, what was that impetus to say, yeah, let's go ahead and list this deal and start going?
all right, so the last deal was had a development component to it. The developer passed away. They were, a pref was accruing, so obviously some challenges from an execution standpoint there. So that was the motivation. That's obviously pretty unique. I think there's quite a few that were maturity driven. There were a couple that were, they've owned for some time, 2019 on one, 2016 on another. So they were, in the black, so to speak, and, had their own motivations, maybe to trade up in quality or, whatever the case may be. So, I mean, I think, you're going to see a variety of different motivations out there, but if you look at the bulk of seller motivations today, specifically in the workforce housing sector, it's going to be maturity driven.
Just like, okay, they took a bridge in maybe 21 or 22, and now they've got to come up with interest rate cap
Yeah,
or to pay down the loan or something. And
yeah,
instead of going back to their investors, they're saying, well, let's see what we can get on the market. And if it's a positive result, as in it's above the loan amount, I think most people are they're moving forward if they can't raise that capital, right?
yeah,
Yeah.
yeah. Every situation is unique because you have a different borrower who's got, a different financial position. You've got a different lender, um, and you've got a different property, which, depending on the age, physical condition, the location. So all these factors play together. And I think generally the consensus across the board, whether that be from the ownership side or the lender side, is that everyone's expectation is there's a light at the end of the tunnel. Fundamentals for multifamily are still, are still solid when you compare to an asset class like office, right? So I think we've seen quite a bit of flexibility from many lenders, but some lenders are not providing that same level of flexibility. So, anyways, each situation is very unique.
And then I remember, even though, let's say in 21 and 22, I felt like there was like 50 deals on the market at any one time, there would
Yeah,
still be like 40 tours on every deal. And so,
yeah.
like, talk about on a couple of your recent deals, how's the tour activity, and then sort of, the process of, going to, call for offers, invest in final. You can pick, I mean, I think we toured a deal up in Denton. You can talk about that one. That was,
Yeah.
yeah, a good sized deal. So,
Yeah. Yeah, I think for the higher the quality of the asset, the more demand there is. So a 1960s chiller deal in South Dallas is not going to have near as much attention as even a 1980s vintage in South Dallas or a 1980s vintage in maybe the mid cities. And then, take it a step further, there's going to be a heck of a lot of demand for 95 and newer, like value add in the value add space specifically. And even for brand new construction, like in lease up or stabilize, there's a ton of demand, not only from institutional equity or operators, but also, family offices and even private capital too.
So in those deals, when you're saying sort of value add, it's been a little bit more challenging to just sort of push rents on a year over year basis on trade outs. And so on the value add piece, are you just bringing sort of the classic units up, or what's usually the story on that value add piece on these deals that are coming to market?
Yeah, and really location and deal specific, right? I mean, there are deals that I've seen that are lagging behind competitors, by the tune of $200, and obviously, there's more risk in today's market, I think, than to come in and renovate to a premium level and try to meet the market there, where you see a lot of operators talking about battening down the hatches, and they've been lowering rents or offering concessions or a mixture of both just to try to drive occupancy, and probably those more so with pending maturities, like in the near term, because they would rather try to hit 95% occupancy to have a little bit of wiggle room, because last year fall and winter were really slow as far as leasing activity. Yeah. So, what was your original question?
Just like, when in 21 and 22, it's pretty easy to underwrite sort of value add, quote unquote, because rents were going up
Yeah,
21%.
yeah,
And
yeah,
so now when you see sort of top line hurting, it's harder to just sort of make that capital investment into the units of 10,000 a door or whatever it needs to be to bring it up.
yeah.
So it's almost like you almost have to use sort of what that property could get to some extent,
Yeah.
and maybe even have sort of flat rent growth for that first year across the top line.
Yeah, I think, I had a 248 unit, two properties that were right around the corner from each other in Denton. And those properties in particular, where the rents were top of the market, and they had a clear delineation between classics and premiums. But in today's market, the delta was only $100. And so to take a classic to a premium level, depending on who's doing it, could cost anywhere from, and also depending on the size of the unit, but let's say, 8 to 15,000 a unit. And you just can't get the return on investment if you're spending that much money and only going to increase the rent $100. So I feel like the value add today is really like, buyers they're buying a low cost basis, so they're coming in, or a low purchase basis, and not putting in a lot of money. I mean, generally having some money for make readies, having some money for deferred maintenance. Maybe, there's some amenity drivers that can make their property more competitive, whether it be, covered parking or washer dryer connections or something like that. But it's really like, how do I keep my basis low, place debt that allows some flexibility, operate it well into, hopefully a better environment, and then at that point sell or refinance in 3 to 5 years.
And are a lot of the deals that you're taking the market, are you seeing people fly in from, California or New York or Chicago, or, these some of these coastal markets, and or is it local guys bidding on these deals that you're selling right now?
Yeah, I mean, in the value add space, I mean, and probably even more so in, like, more of the institutional quality assets, but we still have a very heavy demand from the coast.
Hmm.
Florida, the tri-state area, West Coast from Seattle on down to, San Diego. So, yeah, there's still a lot of out-of-state buyers, and I named those. I named the coast, but obviously we have buyers coming from everywhere in Dallas, and that's one good thing. It's such a liquid market. It's got to be the most liquid market in the country. So we have buyers coming from everywhere, as well as a very strong local presence. I don't have the data today, but I'll have it at the Old Capitol Conference. So
Okay, there
everyone
you
make
go.
sure they're there, and I'll tell you the exact amount of in-state versus out-of-state buyers.
And then, okay, so let's say I'm prepping to sell in a better environment. Let's say next year. So let's say supply sort of tapers off. I want to sell back half of 2025. What should I be doing now as an owner to get ready to sell in, let's say, second or third quarter of 25?
I mean, my answer would be it just depends on, the asset and, where it's at financially and physically. But, ideally, like you've got the cash to be able to kind of physically prepare for the sale. Um, and that's just going to depend on the asset, obviously, what you need to do. In the lease, hopefully a little bit of landscaping and spruce everything up. Outside of that, financially, the value difference in a property that qualifies for agency versus doesn't is pretty stark. So although there's some alternative options out there, depending on the deal and the size, as far as like, I know CMBS has really made a comeback. And maybe they don't have some of the same parameters like 90 for 90% occupancy for 90 days or whatever the case. But generally it's I think you want to have a deal that's stabilized. So you're going to maximize value by having a property that qualifies for agency debt. So I feel like that's probably one of the most widely expressed tips, or whatever you want to call it, that I provide to owners who are maybe hovering in the 80s and really want to sell, is to get it up, get it stable.
Yeah, I mean, especially, on maybe some of these smaller deals that are, 50, 100 units, all of a sudden, you have 3 or 4 people move out, and then all of a sudden you're 85 instead of 95, and you can't qualify for agency, and now someone has to use a bridge loan that costs them 8.5 to 9% to start, and then some people just won't do it. And so that's sort of, I mean, I would say it's almost like 100 basis points on your cap rate if you don't get an agency, or you can't qualify for an agency on a deal. Um, and then what about on the buying side, right? So a lot of people, they're like, okay, Mark, I get it. The basis has been reset by, let's say, 20 or 30% on majority of deals. And so now I'm coming to Dallas. I got outbid in 21 and 22 by everybody else, but now I really want to come to Dallas. Uh, on if I want to be a buyer, how should they interact with you like today? Because let's just go with today. Because or what should they be doing? What should these buyers be doing? Like what's going to separate them from the other guy that calls you after this meeting?
Well, I mean, there's not that many deals happening. All right. I mean, we even like compared to there was obviously a bit of exuberance, and transactions went, we had like 9-10% of our market turnover in 2021 and 2022. Normal years around 5%. Then we were down to like low twos last year. So there's not that many deals. And if you can find something that pencils, obviously it's really valuable, especially as like a real estate private equity or syndication. So I don't know. I mean, what have I been offered? I've been offered finder's fees, like, for off market deals and things like that.
Or more just
Um,
like when they, let's say someone calls you, like what do they need to have like lined up so that when you do see a deal, you call this person, right? Does that make sense?
yeah,
Like what do
yeah,
you
yeah.
like to see in
Obviously,
terms of because I mean, I get this all the time, but you probably get it 10 times as much is everybody says, yeah, I can close cash like tomorrow. and I own all this stuff everywhere, right? Like,
yeah.
and then they get under contract, and then all of a sudden they have no money and they can't find they can't find the equity. Like, what just happened, right? So,
Yeah.
how does a buyer sort of prove up that they're willing to step up on a deal?
So you're saying if they don't already own in the market,
Right. That's right.
maybe they're
Like
newer to
they're
the game.
yeah.
Yeah, I've had a few people do it really well and just come, ask for an in-person meeting. Ideally, we're running as brokers a mile, 100 miles an hour. We're going all over the place, tours, and so sometimes it's nice just to not have to travel anywhere. Like, hey, I'll come to your office, meet you. But then obviously just have everything prepped and ready to go. Like, hey, these are my, myself, and here are my partners. Here are my key principles. Here's my lender. And obviously, like, hopefully these are, reputable sources and people that we all know, like Old Capital, James Ang. Here's my transactional attorney, so on and so forth. So just have your team together.
Team. Yeah.
And I think it's just going to help if you have, yeah, I mean, if you have a story about any of your equity partners, like, I have a really good friend who I went to high school or I went to college with, and he's, or she has sold a company or something like that, and if they find a deal that meets these metrics, that they're going to invest $1 million in the deal or something like that, obviously is really great too. But I don't know.
Because
I mean,
when
it's tough to it's tougher now than any time, in the last 10 years to break into the market, because there's barely any deals around and so many of the sellers want, the most sure deals.
So yeah, because like in 21 and 22, you guys would sort of list the deal, there'd be 40 buyers, and you just meet them at the tour. But now it's sort of a little different where if you have an idea of what that buyer needs, then you know sellers, you know properties in Dallas that could
Yeah,
potentially be opportunities for that person. And you probably just have to
right.
go direct to those people to try to match that up to some extent.
Yeah.
Yeah. Okay.
Yeah, then the other thing is obviously just follow up, and then after that, so then follow up with the broker. It maybe once a month if you're not seeing anything out on the market that you like. Hey, anything come across your desk you think is a fit based on what we talked about? So just keeping in touch that way is probably helpful.
Yeah, and trying to be as specific as possible in terms of sort of locations that you like,
Mhm.
size of deal. I mean, that's usually what when I'm talking to people is like, okay,
Yeah,
can you even qualify for this loan?
yeah,
You're looking at 300 unit deal. It's $90 million. Like, there's
yeah.
no way you're qualified for this loan. Let's scale it back and start at 10 million and sort of work your way up
Yeah.
from there. Anything else? Yeah.
Quick feedback too is helpful. Like for someone, you send a deal, and if they come back, within a day and say, okay, I like this and this, but it doesn't check this box, or hey, this is a great fit, we're digging in. Come back, hey, this is how we're underwriting. I have a lot of buyers that'll share their underwriting model with me, or at
Okay.
least a snip of it, and just kind of talk through the deal and how they're looking at it. I think all that's really helpful.
Yeah, it shows you that they're actually working on the deal and it's not just sitting in their inbox while they're like, uh
Yeah.
surfing away in Hawaii or something. So
Yeah.
um but yeah, no, anything else before we wrap here? Any other tips from you've been in this game for a while, so any other tips for buyers or sellers out there right now?
Um, no, but I'm excited for the old Capitol conference.
Okay. All right. Well,
I don't think I have
okay,
anything
so
else, but
yeah, no, that's no problem. What's the best way for people to reach out to you and learn more about yourself and GREA?
yeah, email is probably best. So mark.allen@grea.com. I'm on LinkedIn, I'm on X. So feel free to look me up there. GREA.com is our website, and pretty easy to navigate. But we've got some good research reports. We've got our properties page is easy to navigate with the map across the country. Yeah, look forward to connecting.
All right, thanks a lot, Mark, and I'll see you probably at the next property tour, but if not, I'll see you at the conference.
All right, man.
All right, I'll
Sounds
see
good.
you.
Thanks so much.